Mbithe, let's start with the shilling because, of course, that was big news yesterday. We saw the rally in the shilling all the way to 92.50. Many traders now saying that this could be a game changer with the CBK taking a more aggressive stance. But the central bank governor Ndungu recently came out saying that selling dollars into the market is not a sustainable action. What do you take of the latest intervention from the governor?
I think the market is definitely reacting positively to the initiatives that the CBK is taking. For instance, today the local dailies were quoting the interbank rate at 12%, which has definitely aided in the rally in the Kenya shilling that we saw yesterday. What the market will be looking out for is the meeting that will be held next week by the MPC on the 14th. So we'll be looking to see what they do to the central bank rate, and again also trying to understand what their views are as regards the interbank rate. But I think for the lower interbank rate, that's definitely a positive. That's definitely aiding in liquidity, and it could correct the currency and the interest rates, at least in the short term.
Many are saying, though, that the central bank sold dollars into the market, and that's why we're seeing the firming. Has this been confirmed from Kenyan side?
Sorry, come again?
Many are saying, though, that the central bank entered the market yesterday to sell dollars into the market. Is there any indication of how much might have been sold?
Not yet, but I think by the end of today we'll probably have a clearer picture as to how much the CBK is actually selling into the market.
Would you say this is a sustainable strategy from the central bank's path, and what type of impact might it have on foreign exchange reserves?
I think generally what the central bank is doing, it has to contend with very many issues. Beyond the currency, it has to contend with high inflation. It has to contend with volatile rates, both on the short and the longer term, on the longer end of the yield curve. So it's sort of in a position where it has to be reactionary as opposed to being responsive to the different things that are happening in the market. And I think looking at the exchange rate, apart from looking at the inflation and apart from looking at the interest rate, would not probably correct the dire macro situation. And I think the central bank actually has to sit down and figure out where they want to be focusing at. I think now the government is also increasing its borrowing, at least from the local front. That will definitely have an impact on the rates going forward. The rates, if they are sustainable for at least the month or the next month or two, then inflation will actually come off and we'll feel that lag effect in December. So I think we're still in a position where we're seeing reactionary moves by the central bank, focusing on the short term, which is on a week-to-week basis. But we need to get more clarity on the central bank in terms of what monetary policy it's actually following, as opposed to being reactionary to what the market is doing.
Let's move on to the equity market. Trade dominated by Safaricom yesterday. More than 2/3 of the trading volumes coming through as a result of trade on that stock. Now it closed at 2 shillings and 95. Of course, this is a closing low for 2011. Do you think the share price is finally based out?
Not so. We're still seeing a bit of supply from the local land and a lot of demand actually from foreign clients. The demand is being driven by the dividend yield on this stock, which is at about 8% based on the last paid out dividend. It closes the books close tomorrow for this dividend. So I think tomorrow will actually be the close date to watch. We expect more demand on the stock today to trade at near or similar levels to what it traded yesterday, and also to continue dominating market activity. The other the banks, which are have actually been trading down, and actually the whole market, we don't expect to see much activity on this. Safaricom will definitely be the driver for today and tomorrow.
CFC Stanbic had a nice bounce yesterday, up 4.5%. Anything driving investors into the stock?
Nothing much. I think if you look at the volumes, it's very, very low volume. So some of this is sort of the dead cat bouncing, nothing exciting coming from these companies. I think for the banks, what will be interesting to see in the third quarter results that should start streaming in sometime end of September, October, is the effect of the tightening liquidity, because this will definitely have an impact on margins, and especially on the mid-tier banks, the likes of CFC and NIC and Diamond Trust Bank. These banks tend to have wholesale funds, which are very expensive. So the margin impact will actually be more pronounced with these banks as opposed to the retail-based banks.
Let's take the discussion to the agricultural sector and what's taking place for sugar producers. Now, Mumias Sugar faces stiff competition from the entry of regional players into the Kenyan market. Omnicane, a Mauritius sugar giant, one of those looking to set up a 16.5 billion shilling plant in the market. Now, if you just look at Omnicane's revenue for 2010, 95 billion shillings, that dwarfs Mumias' 2.6 billion shillings. Surely this is set to shake up the Kenyan sugar market.
Definitely will, but you also have to be cognizant of how much time you actually need to set up your sugar plants, and actually how much time you need to make your fast harvest. So even though you get a new competitor who comes in, by the time they get all the approvals from the different regulators and stakeholders and actually start to harvest their plant, it could probably be anything between 18 to 36 months, which gives you actually a lag before you can start to compete with the likes of Mumias Sugar. Nevertheless, there's the entry of Mumias Sugar next year when the quotas in terms of sugar importations come off. But for these two companies, the Mauritius company is definitely much larger than Mumias, but also on a profitability level, the margins are more or less similar. So it'd be interesting to see how fast the Mauritius company can actually come into Kenya and start producing sugar in Mombasa rather in the coastal region, which is also something Mumias is looking to get into.
Of course, there is a lead time in terms of return on investment, but many are saying, though, that the Mauritian market, sugar market, is a lot more competitive, though, than the Kenyan market, which is known to be inefficient and have high cost of production. So surely an Omnicane with its modern systems would be coming in as a threat.
It should be coming in as a threat, but you also have to remember that Mumias Sugar has actually been trying to set up a similar plant down at the coastal region. And I think the inefficiency of sugar in Kenya is based more on where the sugar is grown in the western area, which takes at least 24 months to get any harvest, compared to about 12 months to get a harvest in the coastal region. So if the Mauritian company starts to harvest its sugar in the coastal region, and Mumias also gets a similar approval and starts operating in the similar region, then the competitive threat will be actually less prone to if Mumias didn't actually have any plans to set up in the coastal region.
And of course, Mumias looking to buy into smaller sugar producers in Kenya in order to build its muscle to counter the increased competition that it faces from next year. Thanks for your time this morning, Mbithe. Mbithe Muema, Equity Research Analyst at Renaissance Capital from our Nairobi studio.